This lecture is presented by John Moffat of Open Tuition. For other free lectures, visit opentuition.com. Right, we're going through paper F9, the June 2015 exam. We've been working through section B and we're now to the last question, question 5. Look at the requirements. A, calculate the expected net present value of the investment project and comment on its financial acceptability, 9 marks. B, critically discuss if sensitivity analysis will assist, can't pronounce it, Raxin, in assessing the risk of the investment project. Part A obviously is the arithmetic, and here it is the majority of the marks, and we can pass it, hopefully, on Part A alone. But as I've said for every question, you must leave time to write something for Part B, however brief. Just getting 1 or 2 marks may make a difference overall between passing and failing the paper. Anyway, Part A. You're on the expected NPV, so you can always expect there to be a net present value question in some form or another. Let's have a very quick rundown of the information and then start doing it in detail. Raxin is appraising an investment project which has an expected life of 4 years, which will not be repeated. The initial investment at the start of the first year is 5 million. Scrap value of 500,000 at the end of the 4 years. There's some uncertainty as to what price can be charged for units produced, as it is expected to depend on the future state of the economy. The following forecast of the selling price and their probability is being prepared. Well, you can see there are 3 possible selling prices in current price terms. 25, 30 and 35, and we're told the probabilities of each of them occurring. These selling prices are expected to be subject to inflation at 4% a year, regardless of which economic state prevails. Forecast sales and production volumes in total nominal variable costs have already been forecast. So you've got the 4 years, the sales, the production units, nominal variable cost. Incremental overheads of 400,000 a year in current price terms will arise. A large proportion relate to energy costs, which are expected to increase sharply, so inflation of 10% a year is expected. And finally, the initial investment will attract tax liable depreciation straight line basis over the 4-year life. Corporation tax is 30%. Tax liabilities are paid in the year in which they arise, and we've traditionally used a nominal after-tax discount rate of 11% per year for investment appraisal. So there's quite a lot there. Clearly there's a bit of expected values, the selling prices are uncertain. Now there's inflation floating around, so we've got to be able to cope with that, and of course we've got tax. So, off we go. I set up the years, I always set them up in columns, as does the examiner. And so how many years is it lasting? 4 years. So 0 is now. 1, 2, 3, 4. Let's now start setting up the cash flows, and where necessary, I'll turn into a little bit of workings. First of all, the operating flows. So we've got the sales revenue. And here I'm going to have to do a little bit of workings because the selling price is uncertain and we're only given it per unit and there's inflation. So we've got 3 things to deal with here. So I'll put workings 1, leave plenty of space, and let's do our workings. Now you can do this in several ways, but by far the most efficient way, since he wants expected NPV, and the only bit there there's any uncertainty is to do with the selling price. So the most efficient way is to work out the expected selling price and then do everything based on that expected price. So what's the expected selling price? Standard expected values. So it's week 35% of 25 plus there's a 50% probability of it being 30 plus a 15% probability of it being 35, which gives me I get an expected price of 29 per unit. And I can now forget all the uncertainty. This is what the question told us now, it was 29. But that is at current prices. And of course there is inflation here. And unless you're told otherwise, we would always, when there's inflation involved, work out the actual cash flows we expect, the nominal cash flows, nominal is actual, and we'll discount at the actual cost of capital, the nominal cost of capital. And so, still in my workings, I need to work out what will be the actual cash flow each year, the revenue, and we'll use 29 a unit, but the sales units change, so it's going to be the number of units at 29, coupled with inflation. So it's still workings, but for each of the 4 years, actually I'll do it in a column rather than that way around. The first year, we're going to sell 150,000 units. At current prices, it would be 29 a unit, but it's a year's time, so it'll be a year's inflation. A selling price is subject to inflation of 4%, so multiply by 1.04. So the cash revenue, the actual revenue, the nominal revenue at time 1, 150,000, 29, 1.04. I'm going to work in thousands, unless you're told differently, always do, but in thousands, 4524. Time 2, well, the sales are 250,000 units. Selling price, 29 at current prices. Inflating at 4% a year, but this time for 2 years, so 1.04 squared. Which gives us, again in thousands, 7,842. Time 3, 400,000, 29, 3 years inflation. It was 29, and I've used that on my calculator. 29 is 13048,000. And at time 4, 300,000. 29 at current prices, 4 years inflation at 4%. Is 10178. So that's all those workings. There's the actual cash revenues I expect. Let's see if I can remember them. 4524 and 7842. 4524 7842. It's easier for you in the exam because you've got both sheets in front of you, but 13048 and 10178. So that's that sorted. What else? What about the costs? Forecast sales production volume. Total nominal variable costs have already been forecast, so we're told the costs. And it does say nominal variable costs, so any inflation has already been taken into account. So these are the actual cash flows. 2385, they're obviously outflows. 4200, 7080, 5730. Any other costs? Below there are incremental overheads, so extra overheads. It's 400,000 a year in current prices. Blah, 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 blah. Inflation of 10% a year is expected. Well, I don't think you should need to show separate workings. It's 400 at current prices, in thousands obviously. If it's inflating at 10%, then in 1 year's time it'll be 400 times 1.1, which is 440. In 2 years' time, multiply by another 1.1, another year's inflation. In 3 years' time, another 1.1, brings us up to 532. And in 4 years' time, another 1.1, 586. So, hope no problem there. Any other costs? No. And so, the net cash flow so far, before dealing with tax, 4524 minus 2385, 440. 2095. I don't know how I've got that, sorry. 4524 minus 2385 minus 440. 1699, that's better. Time 27842 minus 4200 minus 484. 3158. 13048 minus 7080 minus 532. 5436. And finally at time 4. Uh, 3862. So there is the net operating flow. But of course we've tax to deal with. Now if you remember, there are two ways you can deal with the tax and they'll both give the same answer. But the safest, the best, I think the easiest way is to first of all calculate the tax on the operating flows. I.e. ignoring for the moment any capital allowances or tax allowable depreciation. So ignoring the tax depreciation, the tax rate is 30%. And so 30% of each of those operating cash flows, and here it says they're paid in the year in which they arise, so there's no delay as there often is. The tax on 1699 at 30% is 510, and no delay, it's payable in the same year. Similarly, at time 2, 3158 times 30% is 947, obviously an outflow. 5436 at 30%, 1631. 3862 at 30% is 1159. Having dealt now with the operating flows and the tax side, now let's look at the capital flows and any tax saving that results. So the capital flows are the original cost. Well, the cost in the second line is 5 million. Remember, we're working in thousands. So it's 5,000 outflow at time 0. And any scrap value, is there any scrap here? Yeah, the second line, scrap value of 500. at the end of 4 years, so an inflow of 500. However, as a result of that, we are entitled to capital allowances or tax allowable depreciation, which will result in a tax saving. The tax depreciation would mean lower taxable profits, therefore lower tax. So we've now got the tax saving on the capital allowances. I don't really think you should need to have extra workings here. Had it been reducing balance, then yes, it takes slightly longer. But it says we'll attract tax allowable depreciation on a straight line basis over the 4-year life. And so if it's straight line, what will be the depreciation each year? The initial cost was 5 million. We expect a scrap value of 500,000 over a 4-year life is 4.5 million divided by 4. It's 1.125 million. The allowances per year. Now be careful there. He said straight line basis over 4 years, so fine, you calculate the depreciation exactly the same way as you would for financial accounts. The cost minus the expected scrap over 4. On other occasions, he said that it was straight line depreciation based on the original cost. He may have said 25% depreciation based on cost, in which case it would have been 25% of 5 million, which would be different. Here it's 1.125 million a year. However, it's the tax saving that results that we're interested in. And at 30%, 1125 times 30% back to thousands, it's 337.5. Doesn't matter which way you round it. I'll round up to 338 per year tax saving. So apart from the workings, fairly conventional. The remaining thing we need to look at is there any mention of working capital? No. So we've got all the flows. So what's the net cash flow each year? An outflow times 0 of 5,000, followed by, at time 1, 1699, minus 510 plus 338, an inflow of 1527. At time 2, 3158, 947, 338, gives me 2549. At time 3, 5436, 1631, 338, gives me 4143. And finally at time 4, 3862, 159, 500, 338, 3541. So with a one step left, which is the easiest step of all. To get the net present value, we need to discount. And so multiply by the discount factors. We've got the nominal, the actual cash flows. We discount by using the nominal, the actual cost of capital. The nominal discount rate, it tells us, is 11%. So let me find my tables. At 11%, the discount factors for 1 year, 0.901, 2 years, 812, 731, 659, giving present values of and therefore a net present value. Plus 3809, although remember that is millions, 3,809,000. What did it say? And comment on its financial acceptability. Don't waste the orbital mark at the end. Although that's the bulk of the work, to make sure that whatever answer you got, whether it's positive, negative, you make the right comment to go with it. Here, it is financially acceptable because the NPV is positive. If you made a mistake, got negative, you get the mark for saying it's not financially acceptable. But always write, to be certain of getting the marks, subject to the accuracy of all the estimates. There's no need to write more. I mean, he could, as a written, specifically ask you about that, because it's estimates all the way through. Will it last 4 years? Is the cost of capital really 11%? Is the rate of inflation 4%, 10%, whatever? What about those probabilities of different selling prices? So, if any of those change, so potentially could the decision. But that's quite sufficient for what's required here. That's part A. Oh, and before I leave it, I know I've said in other questions, but it's even more critical here. Each bit of that attracts marks separately. You can look at the marking scheme yourself, but some bits will get more marks. For instance, revenue, there was more work involved. Variable costs, obviously, which is copied straight from the question. But each bit gets marked separately. So even if you'd got one of the bits wrong, or you'd made some silly mistake adding up or something, you still get marks for all the other bits, but only if the marker can see what you're doing. So make sure it's clear. Don't just have a mess of figures and expect them to sort it out. You don't need to write a lot. What I've written's enough, but it's obvious here where my revenue figures are, where my variable costs are, and so on. Tax, for instance, I've written tax operating 30%. So even if that had been wrong, I'd still have got full marks for the tax, provided I'd taken 30% of my figure. I'm sorry going on, but I can't overstress. If the marker can't follow it, you risk losing lots of marks, even if you were doing it the right way. What about part B? Part B, critically discuss if sensitivity analysis will assist in assessing the risk of the investment project. Well, it's the last time I'll say it, but without me writing it all down here, read the examiner's answer and learn from it. But at the same time, realise he always writes more than he expects from you. Basically, you're after making. Aim to make it 6 marks. Aim for 6 points. The chances of making 6 points are very remote. But as always, you must write something. However confident you are about part A, you're never certain in the exam you've got it right. Writing anything sensible for part B will start to get you marks. The two main things to say here, one is to make it clear you know what sensitivity analysis is. He doesn't want arithmetic, but explain what sensitivity analysis is. And separately, answer the question, will it help them in assessing risk? Well, what sensitivity analysis itself is, I've already said, and I'm not giving a full lecture again here, but I've already said that all those figures we've used are estimates and are therefore uncertain. And if any of those estimates change or were wrong, clearly, variable costs, those were the estimates. Maybe they were wrong. Maybe it turns out they're all 10% higher or 10% lower. If any of those change, then the cash flows will change, the NPV will change. And provided the NPV was still positive, I'm not bothered, I'd still go ahead. But if ever anything changed to such a degree that the NPV became negative, then obviously we have a huge problem. So sensitivity is measuring what percentage change can we allow before the NPV drops to zero. And it's the level of sensitivity determines for us how worried we are about the individual item. You see, for instance, the scrap, I'm not really bothered on its own. I'm not bothered much at all. Think about it. I don't need to do arithmetic. Even if the scrap value fell by 100% and was only 500, it was zero, I beg your pardon. Even if it turned out to be only zero, but you can see for yourself, the NPV would still be positive. We're not really worried about that at all. It's completely insensitive. On the other hand, look at the original cost. We've done all our estimates, but suppose it turned out the original cost was 10,000. Well, again, you can see immediately that would make the NPV negative. Well, you'd work out the percentage change to get to zero. The smaller the percentage, the smaller the change would have to be for us to have made the wrong decision, and the more worried we'd be. So I've said much too much there, but anyway, that's explaining what sensitivity is. And it is useful. It's got limitations. We're only expected to be able to do it for one item at a time, whereas in real life, all the estimates could change at the same time. However, although it helps us look at the uncertainty there is, that's not quite the same as risk. Risk is when something may be higher, may be lower, but we can actually measure it. If you've made an estimate and it's certain to be a figure, then there's no risk at all. If it might be a little bit higher, a little bit lower, there's a bit of risk. If it might be a lot higher and a lot lower, then there's a lot more risk. Well, sensitivity analysis isn't measuring that. Measuring the risk will be measuring how much higher, much lower could it end up being. And so it's those two things, distinguishing between risk and uncertainty. Risk we can measure, uncertainty we can't, it just exists. And sensitivity, it doesn't measure the uncertainty, but it lets us decide how worried we need to be about the level of uncertainty. Anyway, I hope that made sense. But as I keep saying, read his answer. But there we are. That's the whole of the June 2015 exam.